Hi, and welcome to another episode of the Michael Yardney podcast. Today we've got the big picture episode where once a month I chat with Pete Wargent. And as preparing for this, I was thinking that I'm currently feeling sorry for property investors trying to make a headway in our real estate markets. They're having such challenges. They face the hurdle of significant media misinformation. There's a lot of underwhelmingly and unnecessarily discouraging information in the media at the moment, scaring potential investors. And then, of course, there's the social media, which is full of pretend gurus who are prepared to sell you their secrets to instant riches in property. Of course, what they're doing is really selling you tickets to see unicorns, aren't they? And despite all the information, or should I call it misinformation available in the media and on the internet, the number of investors who succeed in developing financial freedom through property hasn't increased over the years. So my recommendation is to tune out to all this white noise and be selective in who you listen to. I suggest you look for evidence-based analysis, and that's why I enjoy my monthly big picture chats with Pete Wargent, who brings decades of perspective to his views. And again today, we're going to be discussing a raft of macro and microeconomic factors that should give you some clues as to what's ahead for our housing markets.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Around this time last year, the media and many commentators were telling us Australia was likely to be in the midst of a recession by the end of last year. Property prices were also forecast to drop significantly. Some people even estimated the losses could be up to 20% from their peaks. Meanwhile, the banks were preparing for a mortgage cliff, billions of dollars worth of home loans resetting at higher interest rates, and that was expected to cause a raft of distressed mortgagee sales. Now, none of these predictions for our housing markets or mortgage stress played out, and neither did the recession call. The Australian economy remained stable. In fact, it probably performed a bit too strongly for the Reserve Bank's liking. And clearly we've avoided the classical recession despite the cash rate rising to probably higher than most people anticipated at the beginning of the raise of interest rates. And while our economy is still growing, partly because of strong population growth, real GDP per capita, in other words, how much the economy is growing per person, has fallen over the last 3 quarters. And many people are calling this, of course, a per capita recession. So what does that mean? Are we going to fall into recession? Should we be worried? That's what I want to ask leading financial and property commentator Pete Wargent. Hi, Pete.
Hello, Michael. Good to see you.
Well, Pete, the news cycle has moved on, and I guess the two big stories are when are rates cuts coming, but the other one more recently has been about the economy and are we having a recession? Just recently in the Financial Review, there was an article by Bondi Partners senior analyst saying we're in trouble. The GDP numbers are disastrous. Our economy is terrible. What are your thoughts on that? Because the economy has slowed.
It has. I think if you look at, we've been through a very unusual 4 years, I guess, but if you look at a chart of, let's say, GDP per capita, so the growth in the economy per person, we saw during the initial lockdowns, it fell very sharply, a big decline, about 10% or so. But then when the economy reopened, it came absolutely flying back, almost like a square root symbol if you're looking at it on a graph.
Yeah, like a Nike tick.
Yes, or a swoosh. Yes, that's probably a better way to put it, actually. The swoosh recovery. But and in some parts of the economy, things got overheated. There was almost this hedonism period where people could travel again and spend again and go out to eat. And I guess in 2023, the story was really about let's slow things down because inflation was too high, peaked at nearly 8% in Australia or thereabouts. Depending on which measure you use. So all the way through 2023, growth in the economy was slowing. Each quarter slower than the last, and then 0.2% in the December quarter. But actually, if you look at the long-term trend for GDP per capita, it's been slower since the financial crisis, the growth, but we're pretty much back on a trend now with where we would have been had COVID not happened. So yes, the economy's slowed down, but that's actually what the rising interest rates were intended to do.
That's what the Reserve Bank wanted, to slow inflation.
Exactly, just to cool some of that excess. Now, I guess from a housing market point of view, one of the interest rate sensitive parts of the economy is dwelling investment. In other words, housing construction, and that has really slowed, and that's obviously created a bit of a shortage in the rental market. But overall, I think more or less as intended, the economy has slowed down. And as some people have pointed out, GDP per capita actually over the past year has declined by about 1%. So it feels like a slowdown.
Yeah, some people are feeling a bit of a recession because a lot of the growth's really been accounted for by population growth, hasn't it?
It certainly has. And I think the other thing as well is that the interest payments on mortgages have gone up significantly. So the interest rate set by the Reserve Bank basically went to zero through the COVID period, now at 4.35%. That's an enormous increase in mortgage interest in a relatively short space of time. So people have got less money to spend on retail and consumption, and you're starting to see that now. Households aren't saving as much, and also they're not spending as much because more money is going on mortgages. So, and again, that's how the interest rate mechanism and the monetary policy mechanism works, by taking money out of the economy effectively through interest rates.
Well, interestingly, a recent report showed that Australians are spending half their income on mortgage repayments. That's probably a little bit too much. So that was done by the REIA. So I guess the next question is, are we going to fall into a classical recession, Pete? Should we be worried about that?
It doesn't look like we'll get a technical recession. I think, as you said, a lot of the commentary has now turned to when will interest rates fall. If you look at inflation, the year-on-year figures have been falling, but actually now we have monthly inflation figures, and we'll see that since August 2023, there hasn't been very much inflation at all. So eventually that annual figure will come down to the target range. I think one of the things that's being watched very closely by the Council of Financial Regulators, which actually includes the Reserve Bank, is just an increase in financial hardship assistance. So ASIC has been analysing this, talking to the lenders, and yes, loan defaults and loan arrears have been historically low, but they're now rising, and more households are seeking assistance, particularly lower income earning households. So I think everybody's across the risks here, and that is that if interest rates stay too high for too long, yes, more people will go into mortgage arrears and eventually defaults, and that's where you get a risk.
So it's a difficult equation, really, the scenario for the Reserve Bank. They want to slow inflation. They can't drop interest rates too soon, because if they do, people are going to start borrowing, people are going to start spending, inflation will come back. On the other hand, if they keep slowing us down for too long, we could fall into recession. Now, recently, AMP's Deputy Chief Economist said that she thinks we're going to be getting interest rate cuts soon, and a lot. And CBA, Australia's largest lender, forecasts 6 rate cuts in the next 2 years, 3 this year starting in the second half of the year, and 3 next year. So no one really knows how low they're going to get the interest rates. They're not going to go back to the way they were during COVID, though, are they, Pete?
No, I think if you look at what financial markets are pricing, and that is by the third quarter of 2025, so effectively 18 months away, a cash rate target of about 3.5%. Today we're at 4.35. So if you do the maths, probably a few interest rate cuts over that period. As you said, some of the economists are looking for half a dozen interest rate cuts. Nobody really knows about the timing and the quantum, but clearly we're pretty close to the peak of the cycle, and I guess we can expect over the next couple of years interest rates to start falling, which will be welcome relief for a lot of those households, particularly those who bought property when mortgage rates were much lower. I think some welcome relief there.
Well, part of the housing crisis we've got at the moment is because our population growth has surged. And there's different figures. The main figures really are still from the middle of last year, but suggesting our population grew by over 600,000 people last year, driven in particular by a large number of overseas people coming. And there's two sorts of people coming to Australia. The permanent residence, and the government controls that and chooses people to help increase our economy, tax-paying workers, knowledge workers, or people with skills that are necessary to help the economy. But we also saw a huge influx of foreign students. There's been a bit of discussion about that because the question is, are they actually helping our economy or aren't they? And the National Australia Bank recently brought out a statement about this, and David Llewellyn-Smith in Macro Business gave counter-argument. But Pete, let me just say what the National Australia Bank had to say, and then maybe we can give some of our thoughts. But they thought that spending by international students accounted for more than half Australia's economic growth in 2023. That's a huge percentage. They are concerned that if we don't allow students to keep coming in, it's going to create an issue. I mean, I can see that students coming into Australia are helping subsidise our universities. They're making the universities money. And if we don't have the international students coming in, somebody's going to have to pay for the local universities for our Australian citizens to have an education. Either students are going to have to pay more or the government's going to have to subsidise it, and that's not particularly good. But the National Australia Bank said that the international students paid about 40% of their spending on tuition fees and the remaining 60% on consumption of goods and services. So, boy, that was a positive for our economy, Pete.
It depends, doesn't it? I think there's a good and a bad side to everything, and you can have too much of a good thing. I think when people have got a downer on Australia, they tend to say, well, we just do mining. And with the university students coming back, they say Australia is a quarry with good universities or something along those lines. Of course, there's more to the economy than just those sectors. Yes, now the return of international students saw population growth peaking at around 690,000 last year. Huge increase. Of course, that's largely driven by the return of temporary visa holders. Now, on the plus side, that's brought more spending. There is a flip side to that. Wages growth is probably slower than it would otherwise be. I think the other thing that people are really touchy about at the moment is we've got record low rental vacancy rates. So running very high population growth at a time when there's very little rental stock available creates a bit of pressure. And of course, that in itself is inflationary because rents are one of the largest inputs into the CPI. So what we're really seeing here is a normalization of the number of students in the country, and it will start to level off into a more normal level of growth in 2024. But yeah, it's almost a bit of a shock. You get hundreds of thousands of temporary visa holders coming back into the country, and the rental market hasn't responded quickly enough.
Well, what happened was over a couple of years, students couldn't come from overseas because of COVID, and then China changed its rules and said they've actually got to do their education in Australia, not online. Of course, it's also helped lots of small businesses. Remember a couple of years ago, Pete, almost every coffee shop, every restaurant had a sign up wanting baristas, wanting wait people. That's all gone now. So the international students do actually take jobs here as well, don't they?
Yes, and actually I went down to Main Beach in Noosa yesterday, and there was a big long line of backpackers walking up the hill from the youth hostel down there. So yes, the return of backpackers and international students, it feels an important part of the labour market, largely in things like retail and, as you mentioned, hospitality, cafes, bars, that kind of thing. So yes, there were big shortages, especially up here, were really noticeable with the absence of students and backpackers, but that's now come back to normal. And that's another one of the factors that will actually allow interest rates to fall towards the end of 2024. There isn't the same pressure on the labour market now, which is actually softening, with most indicators looking at a rise in unemployment, a slowdown in wages growth. So, and as so often with these things, there's two sides to the equation. So yes, it's put pressure on the rental market, but it has taken pressures off elsewhere in the economy, and ultimately that will help interest rates to come down later in the year.
Well, Pete, you and I keep track of finance figures. We want to understand who's borrowing money, who's getting loan pre-approvals, because it gives us a forward indicator of what's happening to our housing markets. And the latest figures showed some interesting trends, including one where, in fact, the loan market cooled off in January, fewer borrowers seem to be refinancing. Remember, at the end of last year, most of last year really, there were people refinancing their loans as they were coming through what some thought would be the mortgage cliff, but actually just as their fixed rate loans expired.
Yes, it's interesting that lending for housing actually declined in January. Now, obviously, the monthly numbers can bounce around a bit and shouldn't read too much into 1 month of figures. But when you actually drill into it, yes, refinancing lower. Also, lending for the purchase and construction of new homes is falling again. It's basically at record lows, just as we saw in 2023. So there's one bright spot, and that is Perth. But if you look at lending for new apartments, for example, especially in Sydney and Melbourne, it's just dropped off a cliff. So there's one figure for housing lending, but when you drill into it, there's not much being constructed. There's not much in the way of new apartment projects getting approved or built now. So there's plenty of people transacting in the market, as you know. I'm sure you've seen plenty of investors buying and home buyers, but yeah, for new homes and construction, it's really dropped off.
Well, one of the other interesting trends is that upgraders and downsizers seem to be holding out at the moment. Maybe they're waiting for rate cuts to maximise their borrowing capacity, but clearly investors are back in the market and first home buyers are battling it out too, aren't they?
Yeah, it's definitely, and quite a lot of competition for similar types of properties, I think. Certainly seen that in Brisbane around, the $800,000 price point. You've got investors looking there. You've got some first home buyers trying to get a first home in that kind of price range. So yeah, investors are coming back. Not every investor. I think some of the existing investors in the market are selling up. You do see some properties that are for sale tenanted. And I guess that's where I think sometimes investors had lower mortgage rates when they started their journey, and now the cash flow is not working for them. But generally, there is more interest in the market now.
Well, one of the things you mentioned a second ago was the fact that we're not building enough apartments, and currently, we've spoken about it before, they're just not financially viable. The cost of buying the land in those right locations and then building a very expensive construction technique of high-rise apartments just doesn't make it work. So there was some talk about converting some old office buildings into apartments, and that makes sense, or it seemed to make sense. And thousands of new apartments were planned in the Sydney CBD because people aren't using the offices. But a lot of those plans were cancelled or delayed because construction cost even for those was too expensive, even though the building bones was there, the shell was there, just to rearrange things, to convert office towers into units, and then the financing for it, and would somebody even buy them? That's actually taken a lot of property potential, new properties out of the market, Pete.
Absolutely, yeah. So I think it's partly construction costs. So the Fin Review did a piece on this and said construction costs are up at least 40% since the pandemic. And in Sydney CBD, they mentioned 9 commercial to residential developments that are approved but just haven't begun to be constructed. So, and there's a couple more as well of resi projects that have just not gone ahead. And it sounds good on paper, converting an office into units and apartments, but in practice, it's not that easy. I was interested to see, it was about 4 or 5 years ago, 175 Liverpool Street. You might recall my wife Heather used to work there back, this probably 10 or 15 years ago. And it wasn't great. It's an old office tower, the old sort of battery hen type setup. And, it would look, in terms of location, it'd be the perfect place to turn into a couple of hundred apartments, but nothing has happened in 5 years. I think it's not as easy to convert an office into apartments as you might think. You end up having to more or less gut the entire interior of the building and rebuild it. And it's with costs of construction up by 40 or 50%, it's just not stacking up, basically. And that's why we're starting to see these big undersupply of apartments, especially now in Sydney and Melbourne. There's just not enough that makes sense to get constructed.
Well, if you think about where the services are in office buildings, usually the toilets and wash facilities are central, often close to the lift wells in the middle of the building. And if you're going to build apartments, that really wouldn't work. You'd have to change all that. But interestingly, I was speaking with Ross Elliott, an urban planner, a couple of weeks ago on this podcast, and he made a great suggestion. They'd make good schools, because for all these people coming, we need to have more schools for their children. And I said, yeah, but Ross, they're in the CBD. He said, that's exactly where we should be putting schools, because our transport system's a hub and spoke system, and a lot of parents and workers are still going to the CBD. So that was an interesting thought, Pete.
Yes, vertical schools, actually around Brisbane CBD in the Valley. It was something that was mooted a few years ago. Why not have classrooms built on a vertical basis? You still got access to things like swimming pools and other inner city facilities. And it does make sense when you think about utilisation of space. It's a bit different from what we got used to as kids, but times change, especially for people living in the inner city.
Where's the playground going to be? Remember, that was the best time of the day.
True.
When you could go out and kick a ball.
Yeah, especially for people like me with a short attention span. You need some outdoor space for sure.
Yeah. Well, we talked about the cost of new apartments being so expensive. So I think that brings us to another thought. What's happening to current apartments? And in my mind, there's some really good family-friendly apartments. I'm not talking about the high-rise towers that were built in the last decade or so, which we know many of them have got issues. In Melbourne, there are cladding issues. In Sydney in particular, there are structural issues, and almost every new building seems to have water issues with their balconies and their roofs. But if you look at the family-friendly apartments built beforehand, which actually had some charm, had generous space, more comfortable living, nestled in neighbourhoods that sometimes had trees and heritage protection, I think they could make appealing investments, because not by the end of this year, but in 3 or 4 years' time, they're going to grow significantly. Now, what I'm saying is not the end of this year. There is going to be a move to apartments. People are going to trade backyards for balconies. But when that next wave of new apartments comes, Pete, and they're going to cost 20, 30, 40% more to complete, and they're going to have to, the cycle is going to move on. Boy, established apartments that you buy today are going to look so cheap.
Yes, in fact, we've actually seen something similar in Brisbane over the past 3 years. So we had 12 years or so where prices didn't move at all, and now asking prices are up more than 50% in 3 years. Melbourne's going to see the same thing, for the same reasons, I guess. One of the principles of investing is to buy stuff for under market value. And as you touched on there, if you're buying an established apartment, not the big high-rise towers that we were speaking about in the previous segment, but the boutique developments where you've got 4, 6 or 8 units in the project, little boutique stuff that feels homely, feels like a house to live in, or a home. Well, the replacement cost is, you're buying for under replacement value. And in Sydney and Melbourne now, there's just nowhere near enough apartment supply. The gap between house values and unit values in Melbourne is now the biggest it's ever been. It's more than 50%. So, I think if you choose carefully, you'll probably see exactly what's just happened in Brisbane, a 50% increase in unit values. It hasn't happened everywhere in Brisbane, by the way. Some of those big high-rise towers haven't seen the same growth, but the types of established apartments that you would favour, I expect they'll have a very good few years ahead.
Well, some people say, but apartments don't have a land component as the land that increases, but I disagree with that. If you own an apartment, you're going to get a rating certificate based on its land value, and the council will divide the overall land value by how many apartments. So if you're one of 300, boy, you don't get much land value. But if you're, as you said a moment ago, in a block of 6 or 8 or even 10, I would rather own an apartment in a block of 10 in Bondi or Coogee or Armidale or Toorak or South Yarra or Elwood than one and 200 in the CBD. So we're not suggesting that you should go out and buy these new apartments. I know that people say you get tax depreciation, but typically they wear off after a couple of years, and basically there's very little capital growth in the first years of those new apartments. But established apartments that have got a good floor plan, that have got usable balconies, low density, I think that at the moment you're buying substantially below replacement cost, Pete.
There's somebody who owns a few apartments myself.
I know you do, and I do.
Yeah, so I just try to be counter-cyclical. So last one I bought was in New Farm in Brisbane in 2017, when there was an enormous oversupply. Everybody was panicking. The media was talking about, units will always underperform. You can pick up stuff for so cheap. the growth, I guess, over the past 3 years would have been over 50%. That's really the principle. Now, Sydney and Melbourne have underperformed for units since around about 2017. But if you think about what were the dynamics in the economy that allowed that overbuilding to happen, very low interest rates. We had an unprecedented demand for new apartments from Chinese investors in particular, from overseas. So the quality of what was built was questionable because it was more or less being sold out of catalogues and brochures. But we don't have those same dynamics now. Construction costs are way higher. Cost of money is much higher. Foreign buyers are in the market, but nowhere near to the same degree. So new apartments are going to cost a whole lot more in the next cycle. And that's where that relative value comes into play for established units.
Sure. So again, we're not suggesting to try and time the market, but if you can buy below intrinsic value, and the fact that more of us are going to want to, as I said a moment ago, trade backyards for balconies and courtyards, partly for affordability and partly because people still want to live in those suburbs because of the lifestyle factors there, the great suburbs. I'd at least suggest considering buying apartments. Now, Pete, we actually haven't personally caught up for a while, but we're looking forward to catching up face-to-face on at Wealth Retreat at the end of April. I mean, we catch up and we chat personally, privately, and also on these podcasts. But you're coming back to Wealth Retreat, and I know you always sit at the back of the room, despite you having been there year after year, planning the next stage of your life. And that's really what Wealth Retreat's about. The theme of Wealth Retreat is where you're going to be in 5 years' time in April 2029 in all areas of your life, not just property, but also with relationships, with health, with spirituality, with contribution, with recreation. So people come in with a whole lot of ideas and walk out with some firm plans. But I think there's two things I like about Wealth Retreat. There's the fantastic faculty, but there's also the people that are there. And I know you always make yourself available, as do most of the faculty, the ability to just have breakfast, lunch or dinner with you, chat with you, pick your brain. It's a nice group of people, isn't it?
It definitely is. Yeah, you can't see on a podcast, but I've got a little smile on my face. As soon as you mentioned a week at the Gold Coast, I actually had an email chat with your wife, Pam, this week about which days we're playing golf this year. But yeah, it's a great period of time to spend. And actually, if you look at the faculty of people, there's some familiar faces there like Mark Creedon and for business coaching and Ken Race to get your tax and structuring right, and Andrew Wilson on the property markets, and a lot of other familiar faces like Simon
Kirstenmacher is always very popular. He's going to be talking about something that's going to be really useful for business people, but also for property investors, our demographics, where we're going to be, what the big drivers are going to be that are going to drive our, not just our housing markets, but also our business markets.
Yeah, absolutely. And I think, as you said, I've been going to Wealth Retreat for a decade. I always look forward to the week just to take a step back from everything else and make a few strategic breakthroughs. I think you get so much benefit from being around like-minded people and a diverse range of people, I guess. And yeah, you pick up strategies, in terms of borrowing, in terms of business, in terms of investing. There's just so much. And I think the thing I always get really just the planning, set myself a plan for the year ahead and the 5 years ahead and get someone to hold me accountable. And yeah, I just look back to where I was a decade ago and the results speak for themselves, I suppose.
Well, we've got a lot of very successful investors coming back, and they're coming back because they believe it does help them as well. But don't count yourself out, because you're going to get a concentrated version of everything we know about property tax, finance, property development from our faculty. But the great thing is the opportunity to network with a group of successful movers and shakers, like-minded people, and walk out with a holistic plan, not just in property and wealth, but in all areas of your life. So join Pete and me at Wealth Retreat, wealthretreat.com.au. Find out all about it. Register your interest. You can't book in. I speak with everybody who joins us to make sure you'd get benefit from the 5 days. And Pete, I look forward to, we'll have one more big picture chat beforehand, and then we'll catch up on the Gold Coast. Thanks for your time today. Oh, sorry, Pete, before we do go, people will probably want to know a bit more about you anyway. How do they keep in contact with you?
On a daily basis, Pete Wargent Blogspot is my daily blog.
I get that every morning. You're very regular with it. I enjoy it.
Good to hear. Or petewargent.com, or usually on Twitter every day. But
what do you mean usually?
Addicted to the socials, yeah. But the best place to catch up, come along to Wealth Retreat. It's worth every cent. And yeah, I think it's only a matter of weeks away now. So book yourself in and look forward to catching up on the Gold Coast.
Thanks, Pete. You can see why I enjoy my monthly chats with Pete Wargent. And if you got some benefit from today's show and you don't currently subscribe or follow this show, just stop for a sec before we keep moving on and subscribe so twice a week, or whatever podcast app you're listening to, subscribe so twice a week you're going to get the information from my expert guests and me. Now, it wouldn't be bad if you left us a review as well. Give us a whatever star review you think the show's worth. That just helps more people find the show. Now, in a moment, I'm going to share my mindset message with you, but I hope you could see the depth of information Pete Wargent brings, and he's going to be one of the faculty at Wealth Retreat this year at the end of April. It's actually not too late, and please don't count yourself out. We've got the best faculty I could put together, but a great group of people coming back as well, and Pete is going to be there to have a chance to talk with you. You can ask him your most important questions. By the way, you can do that with all the faculty. It's designed so that there's huge amount of networking opportunities, because I found a lot of investors find themselves a bit isolated. They don't have the right peer group to get to the next level. So Wealth Retreat is designed to help you design the next 5 years of your life, where you're going to be in April 2029, and in a holistic way, not just property, not just money, but wealth in all sorts of ways. So go to wealthretreat.com.au and find out all about it. Now, Pete and I were also telling you how our property markets are moving on, and they're going to be very, very different this year than they were last year, and in fact the year before that. So if you're not sure what to do, why not have a chat with my team at Metropole? We're much more than just another buyer's agent. We help our clients safely grow into generational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. So whether you're just getting started or wanting to grow your existing property portfolio, have a chat with my team. Go to metropole.com.au. Having a team of Metropole on your side could help you outperform the average investor and give your family the financial freedom you deserve. So why not book a complimentary, obligation-free wealth discovery call at metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to ask you a question. What if today were the first day of your life? Just play along with me for a moment. Imagine you woke up this morning and realised today's the first day that you're on Earth. If you're born today under these exact circumstances in your current body, in the same location with all your knowledge and all your possessions you currently have, what would you do? Would you be disappointed looking at your body and think that part of it's flawed? Or would you be astonished at how all your organs and systems actually work in harmony? Would you complain about the weather? Or would you marvel at how the sun gives life to everything on Earth? Would you focus on everything you don't have? Or would you feel gratitude for whatever force brought you here? You see, most people wake up every day living in the past. They count their mistakes, they beat themselves up with their history and define their self-worth by their failures. But if today was the first day of your life, how could you? You were born today. The person born today has no past, only a future and the present moment. So I guess if I was broke, I'd find a way to add so much value to people that they'd think whatever they paid for my services was worth the investment. If I woke up not feeling energised, I'd start exercising today and give my body proper nutrition. What I'm trying to tell you is yesterday's tragedy is not an excuse for not doing your best today. You can't undo past mistakes. You can only forgive yourself and make a bold new start. Forget not about trying to fix something that seems broken. Focus on starting over and creating something even better. It all starts and ends with you. Showing up with the right intentions is the most powerful commitment you can make to yourself. So today, like every other day, can be the first day of your life. And if that was the case, what would you do differently? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?